Come on in, Ted Oakley, managing partner at Oxbow Advisors. Okay, Ted, this is clearly a dip, and you're saying don't touch it with a 10-foot pole, correct?
Well, I think what I'm saying, Stuart, is that, we have a different kind of market now. So you want to fade the up days, which typically we've been having lower highs and lower lows, and that's what we're really looking at right now.
So you wouldn't be in the market today on this dip. Now, we're down nearly 400 points. You wouldn't be buying in at this point?
I would not, because we're already, in our portfolio is already set. We have a certain amount of cash that they're holding right now. And, if you break those lows of February 9th, you probably will go a good bit lower, more than likely.
How about those big tech companies? I don't think you are a fan of them at all, correct?
Well, it's not that we're not a fan. We've said before, we have partial positions left over now from what we've taken our money out of them. But the problem is I probably have been around longer, so I remember 1999 and Dell and Cisco and Nokia and those types of stocks that everybody, they couldn't get enough of them, and they thought nothing would ever change, but it always changes.
Well, that was called a dot-com bubble, not Nokia, I understand that, but it was a dot-com bubble. You're not likening the current situation with big tech to the dot-com bubble 20 years ago, are you?
Not exactly, because they make more, some of them do make more money now, but what I'm saying is people get enamored with just a certain set of stocks and they can't see the other stocks. It's not that, I'm not trying to say that you're in a dot-com bubble. I'm just trying to say that they get caught up in a number of stocks like that. The only one that's actually gone on from that level to reach higher heights at this point really is Microsoft.
Yeah, oh, yes, I'm glad you mentioned that, actually. As you may know, I do own a couple of shares of Microsoft, but there you go. Now, you say that people should have more cash, that if you look at your overall portfolio, you have X amount of dollars in actual cash, and you think we should have more dollars in actual cash. Make your case.
Well, here's the thing. If you don't have any liquidity, and I'm speaking about people that have a finite amount of money, if you have money coming in all the time, it's a different situation. But if you have a finite amount of money invested, and that's what you have, then when you have prices extremely high, and valuations are high, you have to really create some liquidity, or on the downticks, and you'll go through bear markets from time to time, or even flat markets where you wait it out and you'll find things that are really attractive, and you can't do it unless you have liquidity.
I wouldn't expect you to advise. I mean, look, we're coming up to a weekend. It's Friday lunchtime. We're down 349 points. I can understand why you wouldn't, why you would say don't buy this dip right before a weekend, because you have no clue what China's going to say in the latest round of trade statements with President Trump, and you don't know what President Trump's going to say. So why buy this dip? That's your argument, really, isn't it? I mean, for the strictly short term.
Well, we really don't look at the weekend as much as we do valuations, and we just don't have many things that hit our value screens right now that we want to buy. If we did, we would buy over the weekend. It wouldn't bother us, but we don't have that many things that are on the list.
The one thing I really liked you to say this morning, and you did say it, was about Microsoft. Ted Oakley, thank you very much indeed for joining us. Ted, you're all right. Thanks very much indeed for joining us, sir. We do appreciate it.
Yes, dude.
Yes, sir.
Thank you, Stuart.